Welcome back to the channel, and welcome to today's deep dive. Let me start with a question that should make you think. If you could hold your money in a digital dollar and earn interest just like you do in a savings account, would you keep your money in the bank, or would you move it all into stable coins? That question is not hypothetical anymore. It's at the heart of a fight that's brewing between the banking industry, the crypto industry, and regulators in Washington. And right now, the weapon on the table is something called the Genius Act. The Genius Act, short for the Guaranteed Essential National Interest in the United States Act, was designed to put rules around stablecoins. Lawmakers finally realized that stablecoins, which now process trillions of dollars in transactions every year, needed regulatory clarity. And at the core of that clarity is a simple but powerful rule. Stablecoin issuers are not allowed to pay interest directly to users. The government drew that line because they knew exactly what would happen if they didn't. The banks would face an existential threat. Think about it. Banks survive on deposits. Your checking account, your savings account. That's the foundation of their business model. They take your deposits, pay you a tiny bit of interest if you're lucky, and then lend that money out or invest it to earn more. But what happens if people suddenly realize they can move their cash into stablecoins and earn 3%, 4%, maybe even more, without having to touch a bank? The outflow of deposits would be massive. Banks know it, regulators know it, and the Genius Act is their first line of defense. Now here's where it gets interesting. The law says issuers like Circle, the company behind USDC, or Tether, the company behind USDT, can't directly pay interest, but it doesn't explicitly stop third-party platforms from doing it. So imagine an exchange or a DeFi protocol that takes in stablecoins, invests them in safe yield-bearing assets like treasuries, and passes some of that interest back to users. That's the gray area. That's where the next battle will play out. Because the banking industry is already lobbying hard to shut down those workarounds, arguing that even indirect interest on stablecoins could drain deposits from the banking system. If this all feels familiar, that's because it is. Back in the 1970s, something called money market funds emerged. They gave people higher returns on cash than banks were paying. And what happened? Money flooded out of banks and into money market funds. The banks hated it, and regulators eventually had to step in to create balance. We're now seeing the same movie play out, but this time, the vehicle isn't money market funds, it's stablecoins. Imagine you're an average person in America. You've got $10,000 sitting in a savings account, and your bank is paying you less than 1% interest. Meanwhile, you hear that if you convert those dollars into USDC, you can earn 3 or 4% through a platform that invests in short-term government bonds. What are you going to do? Would you keep your money in the bank for safety and tradition, or would you move it into digital dollars for better returns? Be honest with yourself. That's the exact calculation millions of people could make if stablecoin interest becomes mainstream. And this isn't just about savers, it's about the entire financial system. Banks argue that if deposits flow out into stablecoins, they'll have less money to lend. That means less credit for mortgages, for businesses, for the economy. In their view, stablecoin interest could destabilize lending markets and hurt growth. But on the other side, crypto advocates say the system has been rigged for too long. Why should banks pay depositors next to nothing while pocketing the profits? If stablecoins can offer a fairer return and do it transparently, why shouldn't consumers have that choice? Now let's zoom out globally. The US is the first mover with the Genius Act, but other regions are watching closely. In Europe, regulators are pushing through MiCA, the Markets in Crypto Assets framework, which includes provisions for stablecoins. The European Central Bank is openly debating whether interest-bearing stablecoins should be allowed. In Asia, countries like Singapore and Hong Kong are far more open. They see stablecoins as a way to strengthen their position as financial hubs. And in emerging markets, where inflation is high and banking systems are weak, people already use stablecoins like Tether as their savings accounts. For them, earning interest on stablecoins isn't a luxury. It could be a lifeline. Let's bring it back to the US because this is where the battle lines are sharpest. Banks have powerful lobbyists. They're already warning lawmakers that letting stablecoins pay interest will drain deposits and destabilize the financial system. On the other hand, stablecoin issuers and crypto advocates argue that consumers deserve choice. If technology can give people better returns and safer digital money, why should banks be protected at the expense of consumers? That's the philosophical divide here. Is the system designed to protect banks or to serve people? And here's where I want to pull you back in. If you could earn 4% on your dollars just by holding them in a stablecoin wallet, would you do it? Would you trust a digital dollar over a bank account? That's not a theoretical question. It's one regulators know people will answer with their feet, by moving their money if they're given the chance. At this point, it's worth asking, what's the real risk? Stablecoins like USDC and USDT are backed mostly by US treasuries and cash reserves. In many ways, they're safer than a traditional bank account, because banks can fail, but treasuries are government-backed. But the risk is in the plumbing. If everyone moved their deposits out of banks and into stablecoins, the traditional banking system could lose its core funding. And without deposits, lending slows, credit dries up, and the real economy suffers. So regulators are walking a tightrope. They want to encourage innovation, but they can't let the banking system collapse. Let's talk about consumers again, because this is where the rubber meets the road. For the average person, the promise of stablecoin interest is simple: better returns, faster transfers, and fewer fees. Imagine paying your rent, your bills, even your taxes directly with stablecoins that earn interest while they sit in your wallet. That's financial freedom. But it also raises questions. Who regulates those interest payments? How safe are the platforms offering them? And what happens in a crisis, say, if one of those platforms fails? These are the kinds of questions regulators will have to answer, and quickly. Now let's pivot to another angle: the Federal Reserve. The Fed plays a central role here because interest-bearing stablecoins could weaken their control over monetary policy. Right now, the Fed influences the economy by adjusting interest rates, which flow through the banking system. But if stablecoins start offering rates independently, the Fed's power could be diluted. Think about it. What if stablecoin platforms start competing with banks by offering rates higher than the Fed's? That could create a parallel monetary system, one that regulators can't fully control. This is where the Genius Act comes in as a compromise. By banning issuers from paying interest directly, lawmakers think they've contained the risk, but the truth is, they've just pushed the battleground to a new front. Third-party platforms will still find ways to offer yield. Exchanges, DeFi protocols, fintech startups, they all see the opportunity. And as soon as one player offers interest on stablecoins, others will follow. It's not a question of if, it's a question of when. Quick word from our sponsors: if you're holding crypto, make sure they're secure. Grab a Ledger hardware wallet if you don't already have one. Use our link in the description, it really supports the channel. Okay, so where does this leave us? We're standing at the beginning of a new chapter in the fight over money. On one side, you have banks, entrenched, powerful, desperate to protect their deposits. On the other side, you have stablecoins, efficient, transparent, and increasingly central to how people move money around the world. And in the middle, regulators trying to strike a balance between innovation and stability. It's easy to forget how fast this space is moving. Just a few years ago, stablecoins were a niche product used mostly for trading. Now they're at the center of a global debate about the future of finance. The Genius Act is only the first salvo. More regulations will follow. More battles will be fought. And the outcome will determine not just the fate of stablecoins, but the structure of the financial system itself. So here's my final question for you. Do you think stablecoins should be allowed to pay interest directly, just like a bank account? Or do you think regulators are right to protect the banking system from competition? Drop your thoughts in the comments. Smash like if you found this breakdown useful. Follow so you don't miss tomorrow's episode. And as always, we will see you at the top.